JD.com, a major e-commerce giant in China, has been on a wild ride, making it one of the most volatile stocks on the market. After a rough patch, JD stock has surged over 18% in the past year. In this video, we'll dive deep into JD's recent performance, uncovering the key drivers behind its impressive comeback. We'll examine the company's fundamentals, including its revenue growth, profitability, and market share. And finally, we will assess JD's valuation to determine whether this Chinese e-commerce powerhouse still presents a compelling investment opportunity in 2025. JD is a leading e-commerce company in China, focusing on direct sales and robust logistics network. They operate in a vast market with a massive consumer base. They have key competitive advantages like strong logistics. JD boasts a sophisticated logistic infrastructure, including warehouses, delivering fleets, and even its own drones. This allows for fast and reliable delivery, a crucial factor in the competitive e-commerce landscape. They also have direct sales model. JD primarily sells product directly to consumers, giving them a greater control over inventory and product quality. As focus on authenticity. JD emphasizes the authenticity of its products, combating the issue of counterfeit goods prevalent in the Chinese market. This builds trust with the consumer base. Expanding business segments, JD is diversifying beyond e-commerce, venturing into areas like logistics service for other business, online retail pharmacy, and even financial technology. This competitive advantage positioned JD for a continued growth in the dynamic Chinese market. JD is a $54 billion company trading at a PE of 12.5. Their forward PE is under 9 and their price to sales ratio is 0.35. They have been growing around 17% per year, their revenue, but in the last year their growth is slowing down. Their gross margins are around 15% and net margin last year was 3%, which is really low, but when you compare other companies like JD, if you compare in the US, Walmart, Costco, their net margins are really low as well. So it's some kind of normal thing of this type of business, even though that is we prefer to see business or buy business with higher margins. It's normal to see companies like JD in the e-commerce or in selling goods to the consumer to have lower margins. This takes another advantage, that is their moat and then competitive advantage. They are not it's really difficult to compete with companies with so low margins. In terms of balance sheet, it is an incredible balance sheet. They have $26 billion in cash and short-term investments. Bear in mind, 1 year ago, JD was trading at with a market cap around 23 billion. I still remember I was buying this company at the price lower than the cash and short-term investments, which was an incredible opportunity. Since then, the company doubled, but this is just a reminder. Their long-term debt is 7 billion, so they are positive when you subtract their cash in hand with their long-term debt. In terms of return on equity of 15% and return on investment of 11%, which is really good. If you compare with other Chinese companies, for example, Alibaba has returns on invested capital under 10%. This is a really good sign. This is another key takeaway, key competitive advantage that they have a management team really efficient. They have been allocating capital really wise. They are creating a lot of shareholder value in JD. So this is something really good, and probably the biggest thing or the thing I most like in JD is their management team, which is incredible. They are paying a dividend around 2% and they are even buying back some shares. When you look into our money on the checklist, revenue growth, it's a check. They've been growing and a really good growth. Margins are not what we expect, but it's something normal in this type of business that they have an incredible balance sheet and they could pay their debt with their cash in hand, and still they have plenty of cash to invest. Their returns on equity and on invested capital are really good, especially for a company with so lower margins. So this means that their management team is really good at allocating capital. In terms of moat and competitive advantage, they have their network effect. They sell some brands that other companies on China cannot sell. So I would say they have a wide moat, because it will be really difficult to compete with JD, because they have the numbers, they have the clients, and they are doing plenty of sales at trying to get the best value for their clients. And even though if you want to buy brands, you have to buy it on JD. If you want to have it next day, JD has the best logistic team in China. They're having free cash flow positive, very stable, and they are returning capital to the shareholders, paying a dividend of 2%. And this year, which didn't end, they already bought 2% of the company. So that is really good signs for a company. But is JD undervalued or a good buy for 2025 after being up 80% since its low 1 year ago? Let's look into it and do our discounted cash flow. It is a Chinese company. Risk, I would say it's median. That's not low. There are plenty of competitive advantage, but I don't like their margins. So for me, there are some risk of competition, especially when you have a company with so lower margins. So with this, my discount rate for my base case have to be higher, so it will be 14.5%. There are plenty of margin of safety because of the risks, of course. So my assumptions for my base case: margin, net income margin, or free cash flow margin. I do really believe JD, after this investment that they have been done, with the return to the mean and consumer confidence going back to normal levels in China, I do really believe they can get 4% margins. In terms of growth, they are expecting to grow 5% this year and 5% in the next. So growth will be around 6 and 4% in the next 10 years. In terms of PE, this is where it gets interesting. I will be conservative. I will assume a 15 PE, which is the mean of the market, I would say. JD, there are plenty of competitive advantage and a moat, but I don't like their much. But it's a high quality business, and I would say that will be enduring for the next 10-20 years on China. I will not blame you if you use a higher PE, but for me it will be a 15. So with this assumption, I will do my bull case and bear case. I'm more optimistic and more realistic, or if something happens in China. And with these assumptions in line, I came with an intrinsic value. Bear in mind, I took the balance sheet as well in these assumptions. So my final value, or the intrinsic value I'm assuming for this company, with some margins of safety already assuming, it will be a $14.8 per share. Right now the stock JD is trading at a $39 per share, so it's close to my intrinsic value, my fair value. It's not a great opportunity as it was 1 year ago, but still a really great business trading at around fair value. JD is a great company on China, and if you are interested in investing in China, in the e-commerce, in one of the most well-renowned companies on China, you have to look into JD. That's my intrinsic value and my opinion on JD, guys. So, is JD stock a buy in 2025? After analyzing its recent performance, fundamentals and valuation, we have gained a clear picture. While the stock has shown impressive growth, it's crucial to consider the potential risks and uncertainties associated with the Chinese market. Investors should carefully weigh these factors alongside JD's strengths, such as its strong logistics network and expanding business segments, before making an investment decision. As always, through research and long-term investment horizon are key to navigating the complexity of the stock market. If you are interested to watch more videos like this, please like and subscribe to Money Journey. See you next time. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.